Welcome to Vold Revolution Channel. Today we present a summary of the book, The Behavioral Investor by Daniel Crosby. And we are doing a deep dive into what I think is one of the most fundamental questions in modern finance. Why do smart people do such foolish things with their money?
It's the central mystery, isn't it? Investors frequently sabotage their own success through psychological pitfalls like overconfidence from ego, resistance to new information via conservatism.
Right, or distraction by irrelevant news, and of course, impulsive reactions driven by emotion. It's all in Daniel Crosby's The Behavioral Investor.
And drawing on sociology, neurology, and physiology, the book exposes how our evolved brains are just, completely mismatched for modern markets.
That mismatch leads to bubbles, busts, and a whole lot of personal financial regret. Our mission today is to really unpack that foundational hardware problem first. We're talking about the fundamental biological machinery that is actively working against our long-term interests.
And once we understand that, we can get into the solutions. The audience was captivated, eagerly continuing to watch as Crosby revealed actionable solutions to conquer these biases, hone focus, manage feelings, and construct rules-based portfolios for true behavioral alpha.
So let's find out more. The critical takeaway, right from the very start, seems to be that our human nature, the very thing that made us masters of this planet, is profoundly ill-suited for the modern world of investing.
That's the perfect way to frame it.
So let's start with part one of the book, which he calls the foundational mismatch.
A great place to begin.
And the first chapter is on sociology. He sets the whole stage with this brilliant thought experiment. He asks you to imagine you're the lone survivor of a luxury airliner crash on a remote island.
Okay, a grim start.
It is. But you're the only human. The only other survivor is, randomly, an Angolan colobus monkey that was being transported from a zoo. You both have to survive for 18 months until rescue. Who has the better odds?
The monkey. Hands down. It's not even a contest. In isolation, its specialized survival instincts, finding food, avoiding predators, just managing its immediate environment, are vastly superior to what a modern human can do.
Exactly. You or I, dropped into a genuinely primitive landscape alone, our prognosis is terrible, despite these big clever brains we have.
But that's where the paradox comes in, because if you change the scenario...
Right, what if the plane was packed with, say, 1,000 humans and 1,000 monkeys?
Then the humans would absolutely flourish. We'd build a society. The monkeys are capped.
And that's because we can flexibly cooperate. That's the sociological superpower Crosby talks about.
It is. Bees cooperate, sure, but their cooperation is rigid. It's instinctual. It's not adaptive. It can't change. They can't decide to form a union and demand more honey.
And monkeys, like other primates, can manage complex social relationships, but that ability seems to max out around 150 individuals.
That's Dunbar's number. It's roughly the size of a social group, where everyone kind of knows everyone else's reputation and intentions. And that cap, it really limits the complexity and the scale of what they can build.
But humans somehow transcended that limit, which is how we build cities of millions of people who are, for all intents and purposes, complete strangers.
We do it by creating what the historian Yuval Noah Harari calls collective fictions.
These are just stories we make up.
Essentially, yes. We invent these invisible stories, we all mutually agree to believe in them, and then we act as if they are physical reality. This ability to conceive of something we've never seen or touched is revolutionary.
Give us some examples.
Well, think of the United States Constitution, or the concept of civil rights, or even just the existence of the state of Alabama. None of these are physical objects you can hold. They're shared narratives.
And our mutual belief in these abstract ideas, our trust in the framework, is what creates orderly, scalable civilization.
Precisely. And that brings us directly to money and capital markets. They are, arguably, the single highest functioning and most widely believed collective fiction ever invented.
Because everyone, regardless of culture or language, agrees that a piece of paper or just a number in a bank account has value. It's the foundation of all global trade.
But here's the rub, and this is the core misfit of the entire book. The very reasoning that made us so successful as a species is exactly what causes us to fail as investors.
So our greatest strength is also our greatest weakness in this specific context.
Yes. We are biologically wired to fit in, to adhere to the communal reasoning. Our brains reward us for following the crowd, for subverting our own ego for the safety of the tribe.
But successful investing often demands the exact opposite. It requires you to stand against the crowd.
It demands independent thought, The willingness to be lonely and, the ability to subvert your ego when that communal narrative is screaming at you to buy at the top or sell at the bottom.
Which our 150,000-year-old brain interprets as an existential threat. Social isolation meant death.
And you can see this failure in the history of economic theory. For years, the dominant model was neoclassical economics.
Which operates under the assumption of subjective expected utility, or SEU.
Right. SEU assumes that you, the investor, are this noble, rational actor. You size up the personal utility of a choice, you weigh it by the likelihood it will happen, and you make a prudent, calculated decision.
Under that model, investors would just ignore the daily market noise, stick to their long-term goals, and always act in their own best interest.
But Crosby argues, pretty convincingly, that this model has almost no descriptive or predictive power in the real world.
Because real humans aren't cold, calculating machines.
Not at all. We were driven by tribalism, by the need for immediate gratification, by emotional satisfaction. We are, as Crosby humorously puts it, increasingly panicked and obese. Our social programming for conformity just doesn't allow for the disciplined, long-term, isolated prudence that successful investing demands.
So our social success is literally our financial downfall.
That's the fundamental mismatch.
Okay, so if sociology explains the external social failure, then Chapter 2 on neuroscience explains the internal mechanical failure. This brings us to the three truths about our brain.
He frames it as a tweed-clad septuagenarian at a steak buffet. It is old, hungry, and impatient.
I love that image. Let's start with the old part, the hardware lag.
The lag is just monumental. Our brains, specifically the neocortex, which handles advanced reasoning, are essentially the same size and configuration they were 154,000 years ago.
But formal, organized capital markets are, what, only about 400 years old?
Exactly. Our mental hardware has not had a software update in a very, very long time.
So we're basically using an operating system from the Pleistocene to run a modern financial trading program.
That's a perfect analogy. Our primitive emotional centers, parts of the limbic system like the amygdala, they were designed to react instantly to immediate threats.
Like a saber-toothed tiger jumping out from behind a bush?
Right. You need to react in milliseconds. These are blunt instruments designed for quick, life-saving reactions. They are not designed for the precise, nuanced calculation required to figure out the intrinsic value of a tech stock.
And that need for rapid, decisive action, the impatient aspect of the brain, is actually penalized in the financial world. The data is pretty clear that more action usually leads to more losses.
It's the ultimate irony. The brain is primed for movement, for action. In a conflict, in hunting, action is life-saving. But in finance, it's corrosive to your returns.
What does the research say on that?
Well, Mere Statman cited research showing that across 19 major global stock exchanges, investors who engaged in frequent trading, all that tinkering, lagged the buy and hold investors by 1.5 percentage points annually.
1.5% a year might not sound like a lot.
But compounded over decades, that's the difference between a comfortable retirement and a major financial struggle. It's the literal cost of our biological impatience.
Our short-term impulse control just isn't built for this.
It's severely limited, especially around financial rewards. Studies show that when you're presented with an immediate smaller reward, the primitive parts of the brain light up. But when you're deliberating on a delayed, larger reward, it's the energy-intensive prefrontal cortex, the rational manager, that has to activate.
And the brain always wants to conserve energy.
Always. So it often defaults to the immediate path of less resistance. We're optimized for the sprint-catching lunch, avoiding danger. But the stock market demands we run a 40-year marathon, and we're constantly trying to switch to sprint mode.
Which brings us to the hungry brain. It's only 2 to 3% of our body weight, but it's a metabolic hog. It consumes 25% of our energy.
And because of that, it's constantly trying to find shortcuts, heuristics, and energy saver mode.
And money, it seems, exploits this hunger perfectly.
It does. Canonical economics always suggested that money has only indirect utility. It's good for what it can buy, but neuroscience completely contradicts this. Money produces the exact same intense dopaminergic reward, that pleasure pathway rush, as primary reinforcers like beautiful faces, good food, or even addictive drugs. It becomes a primal satisfaction in and of itself.
It's basically addictive, and the loss of it registers as something like physical pain.
It does. There was a Harvard study that looked at neural activity during financial losses, and it's alarming.
What did they find?
When participants were losing money, their brain scans showed activity in the nucleus accumbens, which is the key area for reward and addiction. The scans were nearly identical to those of drug addicts high on cocaine.
That's incredible.
So money is so tightly linked to our feelings of survival and pleasure that when it's threatened, we just eschew reason entirely. The rational part of the brain gets overridden by this deep physical need for the emotional satisfaction that money represents.
And our perception of risk is skewed even further by the power of our early experiences, what he calls the irrational primacy effect.
Ah, yes, the power of the first lesson we learn.
Can you explain the sitter example he uses?
Sure, it's a fantastic illustration. If I introduce a potential babysitter by listing their traits, starting with the positive ones, intelligent, industrious, impulsive, versus starting with the negative ones, envious, stubborn, critical, you will view the first sitter far more favorably.
Even if the list of traits is exactly the same, just in a different order.
Exactly. We assign much greater weight and cognitive importance to information that comes first. That's the primacy effect.
In capital markets, this creates what he calls market imprinting.
Right. And it can be incredibly inappropriate. If you started investing right at the market peak in late 2007, your subjective experience of risk is going to be incredibly cautious, probably far too conservative for long-term growth.
Whereas someone who got into the market in the early 1990s during a long bull run is likely to have an overinflated, rosy view of how easy it all is.
Your limited lived experience disproportionately defines your personal internal sense of risk. The only solution is intentionality. You have to become a student of market history to overcome the limits of your own personal timeline.
You have to fight the imprinting your brain has established based on a tiny sample size of reality.
And finally, the last part of this brain problem is that it's never satisfied. We're perpetually running on what's called the hedonic treadmill.
Always chasing a moving target of enough?
This is all about how our dopamine system works. Anticipating a reward, imagining a successful IPO, talking about what you'd do if you won the lottery, that triggers a massive dopamine flood. It's deeply satisfying.
But actually receiving the reward often leads to a neurological yawn. We adapt to the new reality almost instantly.
Exactly. Imagined rewards have no ceiling. Real rewards are bounded by reality. So we're always rolling a rock up a hill only to have it roll back down. It's a Sisyphean struggle.
This means enough is always a moving target. The Gallup polls on this are fascinating.
They are. They show that the amount of money a family says it needs just to get along increases in direct lockstep with that family's current income. You just adjust your baseline.
But there is one interesting measurable inflection point. The famous $75,000 study from Daniel Kahneman in Princeton.
Right. They found that up to an annual income of about $75,000, money dramatically improves quality of life. And it does that by mitigating existing worries.
What do you mean by mitigating?
Well, it's about reducing the stress associated with difficulty. For example, among divorced people making less than $1,000 a month, over half reported daily stress. That number plummeted to less than a quarter for those earning over $3,000 a month. Money provides security. It softens the blows of life.
But, and this is the key finding, that positive relationship between income and emotional well-being just vanishes at that $75,000 mark.
It disappears entirely. Beyond that point, your quality of life depends almost exclusively on your individual attitudes, your health, and your ability to control the tendency to compare your wealth to others.
So we've got this old, hungry, impatient brain, but our body is also an active participant in betraying our rationality. This is the focus of Chapter 3, Physiology.
Right. We tend to think of emotion causing bodily states, but Charles Darwin observed the opposite. He said bodily states can induce or increase emotional responses. He who gives way to violent gestures will increase his rage.
So it's a two-way street.
Absolutely. And understanding the impact of our physiology is a seriously underappreciated area of study. It's a potential source of outperformance because almost no one thinks about it.
And it all starts with the concept of homeostasis.
Homeostasis is just our body's primary role, maintaining physiological balance, a stable heart rate, a core temperature of 98.6 degrees. Any deviation from that set point feels bad. It's a powerful cue to correct course.
And thinking about a big financial position or watching a market correction is the definition of a disruption to our homeostasis.
It is. Just thinking about money, especially when the stakes are high, causes physiological arousal. We rapidly depart that comfortable balance. We head straight for what Crosby calls freak-out pass.
And when that arousal gets excessive, it actually hurts our ability to think.
It decreases our working memory and cognition. Your brain needs every bit of its processing power to rationally assess the market. But your body is shunting that power away. diverting resources to prepare you for a fight-or-flight response.
Which is completely useless when you're just sitting in front of a computer screen.
Useless and actively harmful.
This is where seemingly trivial physical things can derail very serious, high-stakes reasoning. The famous hungry judges example is probably the best illustration of this.
It's almost funny, but it's also terrifyingly true. Researchers studied these Israeli parole board judges, who had, on average, 22 years of experience. These are supposed to be the height of rational experience judgment.
What did this study find?
It found that the judges granted parole about 65% of the time right after they had a meal, whether that was breakfast or an afternoon snack.
And what happened when they got hungry?
That leniency just plummeted. Right before lunch and right before their afternoon snack, the parole rate dropped to nearly zero. Their complex, high-stakes, rational judgment was measurably compromised by the simple variable of hunger.
So a drop in blood sugar made these experienced legal experts more punitive and more conservative.
And this tendency generalizes into greed as well. Studies confirm that hungry people desire money more intensely, and they take statistically riskier financial bets.
That makes evolutionary sense, I guess. If you're starving, you're selected for risk-seeking behavior because the potential gain food outweighs the immediate risk.
But in the modern financial context, this translates into disastrous portfolio decisions prompted by something as simple as skipping lunch.
And then there's the incredibly counterintuitive study on inhibitory spillover. This is where a random bodily restraint actually improved financial discipline.
It's a wild one. The study found that participants who were experiencing a high urgency to urinate, a profound non-financial bodily restraint, actually chose the delayed, larger financial reward option significantly more often.
So the secret to financial success is always needing to go to the bathroom.
That's the joke, yes. But the serious implication is that bodily restraint, even if it's completely unrelated to finance, can transfer its effect. It can create patience. It just shows that our risk preferences are not stable traits like height or eye color. They are shifting, physical, and highly contextual.
Speaking of shifting traits, let's talk about stress. We often think of it as purely emotional, but it's profoundly physical.
The term was coined by Hans Selye in the 1930s. Stress is a chemical and physiological cocktail, a surge of cortisol and adrenaline, a racing heart, all designed to prepare the body for movement.
Which is great if you need to run from a predator.
But if you're financially stressed during a bear market, which on average lasts about 500 days, this physical response is profoundly ill-suited. You're physically ready to run from the threat, but the most profitable action is to just sit still and wait.
And the cortisol itself actually changes our risk profile, doesn't it?
Fundamentally. The research by John Coates is definitive on this. He found that elevated levels of cortisol led participants' appetite for risk to fall by an incredible 44%.
44%, that's a huge drop.
Think about the magnitude of that. If a hormone can unilaterally cut your risk tolerance almost in half, then any assumption you have about possessing a consistent, stable risk profile is just completely undermined. Your body is changing your mind without your conscious consent.
And finally, the body holds on to bad experiences with incredible tenacity. It's what fuels loss aversion. Fear, as Crosby puts it, is intransigent. It refuses to be suppressed easily.
The Ledoux rat study illustrates this perfectly. They conditioned rats to fear a specific tone. Then, they severed the connections between the cortex, the reasoning part of the brain, and the amygdala, the primitive fear center.
And what happened?
The cortex successfully suppressed the fear response. The rats acted normally. But Ledoux found that the fear was still there, hiding, completely intact within the amygdala.
Ready to pop back up?
Ready to resurface immediately when similar bad news emerged. The body hangs on to fear for self-preservation, which makes us highly attuned to and defensive against losses, even if they're statistically minor. To be a successful long-term investor, you have to manage that fear, which your evolved biology makes extremely difficult.
Okay, so let's make the transition. We've established the hardware problem. Our sociology demands conformity, our old brain is impatient and hungry, and our physiology creates a stress response that makes us want to flee. So the next question is, how does all that physical panic translate into the choices we actually observe?
And that brings us to part 2 of the book and the 4 pillars of behavioral risk: ego, conservatism, attention, and emotion.
This is the practical framework for managing all this.
Yes, behavioral finance has identified something like 117 different biases and heuristics, but Crosby wisely consolidates them into these 4 primary pillars. And since successful investing is fundamentally about risk management, understanding these 4 core psychological risks is the prerequisite to achieving any meaningful behavioral alpha.
Let's start with the first pillar, ego. This is fueled by overconfidence, which Daniel Kahneman called the one cognitive bias he would eliminate if he had a magic wand.
And it's rooted in what Crosby calls the self-love fest. We fundamentally believe we are better than average across the board.
It has an evolutionary purpose, though.
Oh, absolutely. Overconfidence increases our resolve, our ambition, our persistence. It helps you compete for scarce resources in leadership positions. But in finance, where competence is quantifiable, this self-assessment is disastrous.
The classic example being the survey of professional fund managers.
Right. 74% of them believe they delivered above-average performance. Mathematically, of course, only half of them can be right.
And Crosby breaks this down into 3 specific types of overconfidence. Can you run us through those?
Sure. We have overprecision, overplacement, and overestimation. Overprecision is just excessive certainty in our private beliefs. We're driven to be useful. If you ask me how many books are in the Bible, I won't say somewhere between 1 and 10 million, even though that range is technically correct. I'll give a narrow, useful, but probably inaccurate range. We confuse certainty with accuracy.
And overplacement is the fund manager problem, believing our personal skill is higher than our peers.
Correct. And finally, overestimation is unrealistic optimism. When we estimate the likelihood of positive events, we tend to overestimate them by about 15%. When we estimate negative events, we underestimate them by about 20%.
That asymmetry is our ego protecting us.
It is. When people are shown negative factual information about, say, their cancer odds, they barely revise their personal risk assessment upward. But if the news is positive, they're very quick to integrate it.
And to maintain this self-love fest, we engage in a 3-step ego preservation process. We seek supporting evidence, we congratulate ourselves when we're right, and we react violently to attacks when we're wrong.
That whole defense mechanism is the engine of what we call confirmation bias.
Which is the tendency to actively seek out information that agrees with what we already believe.
Instead of asking the much harder, more necessary question, which is, why might I be wrong? The late author Terry Pratchett captured this perfectly when he observed that people don't crave news, they crave olds. They want to be told that what they already know is true. It's comforting. It validates our past choices.
And modern media and our social structures have made it incredibly easy to live entirely inside that echo chamber.
The data absolutely supports this. A study from Ohio State found that people spend 36% more time reading essays that align with their current views. Or think about your social circle. In the 2016 election, researchers noted that a majority of voters on either side didn't have a single close friend who was voting for the other candidate. We build these bubbles.
And in finance, the proliferation of specialized news makes it simple to only consume material that confirms your existing investment thesis.
And once we've made a choice, our ego ensures that we defend it aggressively through something called post-decision rationalization.
The free choice paradigm study on this is fascinating.
It is. Participants were shown a series of paintings and asked to rank them. After making a choice between 2 similarly ranked paintings, they were retested 2 weeks later. Invariably, they re-ranked the painting they chose higher and the painting they rejected lower.
Why?
Simply to maintain a belief in their own rational, excellent decision-making ability. We have to believe our past actions were rational, even if they were totally arbitrary.
And even more dramatically, our brains can physically drown out contradictory information when our preferred views are challenged.
The MRI study on political views is just shocking. When subjects evaluated contradictory statements made by a candidate they disliked, their rational centers were active. They could spot the error.
But when it was their preferred candidate?
When they evaluated contradictory statements from their preferred candidate, the emotional arousal was so high that it physically drowned out the error signal. The brain literally overrides its own critical function to protect an emotional belief.
And if we challenge these deeply held beliefs, say, with contradictory statistics or evidence against a stock thesis we hold, we trigger the backfire effect.
Right. We don't change our minds. We actually become more firm in our existing views.
It's so counterintuitive, but it explains so much.
It leads to the stubborn persistence of erroneous beliefs. There was that famous Stanford study where students were asked to sort fake suicide notes and were given false feedback about their skill.
I remember this one.
Even after the researchers fully revealed the deception, the students who'd been told they were gifted persisted in believing they were far more talented than average. A residue of bad belief just lingers, completely impervious to the evidence.
And we see the ultimate expression of this in extremism and cults, where moderate members leave when a prophecy fails.
But the radicals just double down. It's called the evaporative cooling of beliefs. The moderates leave the room, which increases the average intensity of the remaining members, who then look for any reason at all to sustain the original failed thinking.
It's a powerful force.
And it makes objective analysis of your own portfolio almost impossible without a strict system in place.
Okay, so if ego is about believing we're special, the next pillar, conservatism, is about comfort, safety, and avoiding the pain that comes with change.
This is the status quo bias. It's rooted in the comfort of sameness. The story of the German town given a blank check to redesign itself is the perfect allegory for this.
Remind us of that one.
An old German town was completely razed, and the citizens had the budget to build a new, perfect, architecturally beautiful place. Instead, they just designed a town that looked almost exactly like the ugly, haphazard, but familiar place they had lived in before.
The devil you know.
Is better than the devil you don't. Pain researchers found that expected pain is actually less disruptive than unexpected pain, even if the intensity is exactly the same. We prefer predictable misery.
And this preference for the known, even if it's destructive, keeps us stuck.
It's why studies showed that 50% of children of alcoholics often go on to marry alcoholics. There's a comfort and a familiarity in the sameness of those relationship dynamics, even if the outcome is tragic.
And financially, this conservatism manifests as holding on to losing investments for too long or failing to rebalance a portfolio.
Or just sticking with the default 401k option your company gave you, regardless of its performance.
And the mental mechanism driving all this is simple. Thinking is hard. It's metabolically expensive.
We make something like 35,000 decisions every single day. That staggering cognitive load ensures that we default to energy saver mode. We default to the path of least resistance, which is always the status quo.
The research from Samuelson and Zeckhauser showed this pretty clearly.
They demonstrated that classical economic models vastly underestimate how much we stick with our current trajectory. Whether it's voting for an incumbent politician, keeping the same health insurance plan year after year, or failing to switch out of a poorly performing retirement account. The default option wins overwhelmingly because it requires zero energy.
And the more useful the information is that challenges the status quo, the harder it is for us to actually adopt it.
That's the real kicker. A researcher named Edwards found that the more useful the evidence, the greater the shortfall between actual updating and rational updating. Mental fatigue means that the complex, useful evidence that would require a deep, energy-consuming reevaluation of your portfolio is often the first thing to be ignored. We just fall back on our well-trodden mental paths of dubious quality.
This laziness is then reinforced by regret avoidance and the sunk costs fallacy. We feel far stronger regret for bad outcomes that result from a new action we took.
Then for a similar bad consequence that results from inaction, action feels volitional. It makes us culpable for the failure. Inaction can be blamed on fate, which preserves our ego.
The story of Brooke, the PhD candidate, is so poignant here.
She successfully applied and was accepted to several top programs, but she just couldn't bring herself to open the acceptance letters. She couldn't bear the thought of discovering a rejection after pouring so much effort into the applications.
That fear of culpability paralyzes investors. It's the ostrich route, ignoring your statements, refusing to check your balances, staying frozen in a losing position.
And that leads directly to the endowment effect, where we immediately ascribe higher value to things simply because we own them.
The Cornell mug and chocolate study.
The definitive study. Participants were randomly given either a valuable Cornell coffee mug or a gourmet chocolate bar.
Here.
Even though the items had identical market value, only 10% of participants were willing to trade the item they had been assigned for the other one.
We synthesize happiness by loving the one we're with.
Exactly. And if you own a stock, you automatically value it higher than the market does, which makes it incredibly difficult to sell it when you should.
And the most destructive manifestation of all this, the one that really fuels conservatism, is the sunk costs fallacy. We just keep pouring effort and money into a losing venture because of our past expenditure. We favor completeness over quality.
This fallacy has massive historical implications. Think of the Teton Dam, which engineers knew was faulty but was pushed to completion because of the vast sums already spent. Or the Lockheed L-1011 airplane, where billions were poured in despite clear failure signals.
Even the Vietnam War.
A classic example of past expenditure being used as justification for continuation. For an investor, it's that voice in your head that says, I've already lost so much on this stock, I have to wait for it to come back.
But there is a hopeful sign, though, a suggestion that experience can mitigate some of this rigidity.
Yes. There's some new research indicating that experienced sports memorabilia traders were significantly less prone to the endowment effect than their callow counterparts. So if it's hardwired into our nature to cling tightly to what we own, there is at least some evidence that disciplined, repeated exposure to the marketplace can help break that cognitive habit over time.
Okay, that brings us to the third pillar, attention. This is where we confuse the ease of recall salience with actual probability. It's the availability heuristic in action.
And the K-word example is such a great way to understand this.
Remind us.
If I ask you to name words that start with the letter K, you'll generate a bunch pretty easily. But if I ask you to name words that have K as the third letter, you'll struggle.
Even though there are 3 times as many words with K as the third letter.
Right. Our mind just confuses the ease of retrieval with the actual frequency of occurrence.
The foundational problem here is that we think in stories, not in percentages. Vivid, narrative information always trumps boring, factual probability.
The jelly bean experiment demonstrated this perfectly. 2/3 of participants chose a bowl that offered a 9% chance of winning over a bowl that offered a mathematically superior 10% chance.
Why on earth would they do that?
Because the 9% bowl had a physical presentation that offered 9 different storylines of success. People want the narrative. They want the story of how they could win, not the cold, hard math.
And scary stories are the stickiest of all because they have an evolutionary survival benefit. My own fear of sharks, which is statistically absurd, is a perfect illustration of how available, terrifying narratives can completely warp your risk perception.
And this leads to tragic, real-world consequences. After the highly available, terrifying narrative of the 9/11 plane crashes, Americans' perceived risk of flying just skyrocketed.
I remember that vividly.
In the year that followed, 1,595 more people died on the roads because they chose to drive instead of fly. That is a wildly warped risk perception caused by one vivid, tragic, but statistically minor event.
And this dramatically impacts how we view stock market risk as well, depending entirely on where we choose to focus our attention.
If you check your portfolio daily, you will see a loss on about 41% of those days. That's scary, it feels volatile, and it prompts you to take action.
But if you only checked your portfolio, say, every 12 years over the last century,
you would never have seen a loss. Your perception of risk is entirely dependent on your timeline and your attention. We confuse the short-term noise with the long-term trend because the daily noise is so much more salient.
And compounding this problem is information overload. We are drowning in data, which actually leads to decisional paralysis, not better choices.
The sheer volume is just staggering. Humankind produced as much data in the year 2016 alone as it had in its entire history prior to 2015. But this glut doesn't lead to higher quality decisions.
It's the opposite.
Exactly. Studies across all sorts of contexts, from dating profiles to mutual fund options, show that providing more options actually leads to fewer decisions being made because people just get overwhelmed, they retreat to the status quo, or they just postpone the choice indefinitely.
There's also the base rate fallacy, where we ignore the broad average in favor of the salient specific observation.
The breathalyzer problem is the classic example. Let's assume the base rate, the actual occurrence, is that only 1 in 1,000 drivers is drunk. But the test has a 5% false positive rate. Okay. If a driver tests positive, our instinct is to assume there's a 95% chance they're intoxicated. But because the base rate of drunk drivers is so incredibly low, the driver is actually still far more likely to be sober and the test to be a false positive.
What?
We ignore the mathematically crucial base rate in favor of the salient observation, the positive test result.
And this is exactly how the media exploits our attention bias. They focus on the dramatic outliers, forcing us to ignore the boring base rates.
Think about stock market returns. 40% of all stocks actually lose money over their lifetime, and 64% underperform the broad market index. The vast majority of gains come from only about 25% of stocks.
But the financial media doesn't cover that vast mediocrity. They focus on the dramatic 25% that are winners and the spectacular losers.
As one candid news producer admitted, "Don't be a nerd, we're selling news here."
Yeah.
Financial news is designed for maximum arousal and clicks, not to inform. And the result is that investors grossly misappraise actual market performance. Many people thought the market from 2009 to 2011 was down sharply, when in reality, it saw double-digit gains.
Okay, that brings us to the final pillar, emotion. We know emotion is necessary. It's an evolutionary adaptation that dramatically improves our learning efficiency.
It is. People with brain damage to their emotional centers struggle with simple decisions, like what to eat or what to wear, because they lack that quick emotional guidance system. Emotion is a prerequisite for simple decision-making.
It provides the shortcuts our hungry brains need.
Exactly. If you feel intense fear after touching a hot surface, you won't touch it again. It's adaptive for survival. But what's adaptive for survival is frequently destructive for investing.
So when does emotion become the investment enemy?
When it becomes intense and takes over, it completely destroys the rule-based system we worked so hard to establish.
It has what he calls a homogenizing effect.
Yes. Low emotion allows for a heterogeneity of behavior and ideas, a variety of responses. But strong emotion like yelling, "Fire!" in a crowded theater forces a singular, frantic purpose. It makes you a stranger to your rules.
The researcher Brett Steenbarger studied traders and found that during these emotional moments, they didn't necessarily doubt their established rules.
They simply forgot them. Their high emotional state just short-circuited their complex decision-making faculties.
And this emotional reactivity directly correlates to worse outcomes.
The research by Lowe, Repin, and Steenbarger is conclusive on this. They found that high emotional reactivity, both positive like excitement and euphoria, and negative like fear and panic, correlated with significantly worse trading performance. The greater the emotion, the larger the deviation from the discipline process.
Which leads us to the surprising and kind of counterintuitive idea of the functional psychopath. The goal is to remove emotion from the equation entirely.
The Stanford brain damage study is the key here. They show that participants with damage to their emotional processing centers actually outperform their neurotypical peers on complex gambling tasks.
Why did they win?
They won because they didn't feel the need to chase their losses or lick their wounds after a bad bet or get euphoric and celebrate excessive gains. They just maintained a consistent, unwavering style and recovered quickly from setbacks because they had no emotional response.
The neurologist Anton Bichara joked that, based on these findings, investors ought to be functional psychopaths.
They should drive out emotion at every turn to maintain a rational, disciplined process.
And the reason emotion wins this battle so often is physiological. It's the primacy of affect. Our neural circuitry is literally designed for feeling to triumph over logic.
Ledoux discovered a direct neural connection, a high-speed bypass, from the sensory thalamus, where signals are processed, straight to the amygdala, the emotional fear center. This bypasses the neocortex, the center of reason.
So what does that mean in simple terms?
It means signals are processed emotionally before they can be reasoned through. We are afraid before we even know why. The body starts the panic response before the mind can finish its analysis.
So if your thought conflicts with your feeling,
The feeling is designed to win. As Crosby notes, where thought conflicts with emotion, the latter is designed by the neural circuitry in our brains to win. Emotional appeals are stickier in our memory than rational facts, which makes adhering to a predefined, logic-based rule system incredibly difficult when the market turns against you.
And that brings us full circle. We've established that the human condition is just fundamentally a mismatch for modern markets. Our evolutionary hardware rooted in our sociology, our old and hungry brain, and our betraying physiology creates these four core psychological risks.
Ego, which is overconfidence.
Okay.
Conservatism, which is our reliance on the status quo. Attention, which is salience over math. And emotion, the great disruptor of rules.
And investing success, it seems, requires understanding this misfit, understanding the gap between our evolved, biased nature and the cold, rational demands of compound growth.
If you could accept the profound limitations of your own mental and biological wiring, you could finally stop relying on your flawed personal judgment and instead learn to rely on discipline systems.
Which leads us to the ultimate brilliant irony of behavioral finance and the provocative thought we want to leave you with. The key to achieving exceptional outcomes, what Crosby calls true behavioral alpha, is to first acknowledge and fully embrace your own inherent human averageness.
It's such a paradox. The source suggests that owning your personal mediocrity is the key to becoming exceptional.
How does that work?
Because the less you feel the need to be special, the more you encourage reliance on unsexy disciplined systems, rather than on your own hubristic discretion. The challenge for you, the listener, is this. Can you use your powerful, flawed mind to understand the mind and then learn to stop trying so hard?
A perfect place to end.
Thank you for watching. Please like, share, subscribe, follow up in next topic.
Come back to continue the behavioral investor. Over the last few deep dives, we've really done the hard work, right? We've identified the psychological landmines buried in modern finance, all those cardinal risks that can trip up even the smartest people.
Right. But knowing where the mines are is only, half the battle.
Exactly. And we've established that our brain, it's about 150,000 years old. It's optimized for immediate survival.
For the here and now, not for long-term compounding.
And you put that up against modern markets, which are, what, barely 400 years old?
Just a fundamental mismatch. We're analog investors trying to survive in a digital world.
And the natural tendency, I think, is to assume that if you just read enough books, you can, override these biases with sheer mental willpower.
If only it were that easy.
But our mission in this deep dive is to move beyond just identifying the problems, which, let's be honest, is where a lot of behavioral finance literature just stops.
It is. We want the practical prescription, and that's what we're drawing from Daniel Crosby's work here.
So our goal now is really twofold. First, we need to get into the actual disciplines required to become a behavioral investor, the internal toolkit.
And second, and this is crucial, we have to talk about how to build the portfolios themselves, the systems that are designed to withstand the very human frailty we know is coming.
So we're moving from psychology to engineering, in a way.
That's a great way to put it.
Let's unpack this journey into mastery. And I think we have to start with what is probably the most insidious destroyer of wealth out there, the investor's ego.
The big one.
When we talk about ego risk, it's usually about confidence. But the source material hits you with that great line, "Don't be so humble, you're not that great."
It's a necessary slap in the face, isn't it, for anyone who thinks they can consistently beat the market?
It really is.
Because that deeply embedded human need to preserve our own self-worth, that's what drives so much irrational financial behavior.
It triggers confirmation bias?
Exactly. We're not seeking truth. We're seeking validation. We look for information that confirms the investment thesis we've already emotionally committed to.
Which is comforting, but
financially lethal.
I remember Francis Bacon, centuries ago, he observed this. He said, once the human mind adopts an opinion, it draws all things else to support and agree with it.
We're not programmed to ask, is this true? We're programmed to ask, why was I so smart to figure this out?
And that confirmation loop feeds directly into overconfidence, which Crosby argues is, quote, the most significant of the cognitive biases.
You see the proof everywhere. I mean, think about that survey of 300 professional fund managers. They asked them to rate their own job performance.
And what happened?
Almost 100% of them.
Yeah.
Every single one rated their performance as average or better.
Which is, by definition, mathematically impossible.
Completely impossible. It's an extreme case of overplacement where we all think we're above average, even when the numbers say otherwise.
And that kind of overconfidence is just so dangerous. It leads to what? Concentration risk, way too much trading, ignoring red flags.
And historically, the biggest failures, from the Titanic to Chernobyl, they were rooted in experts becoming too certain of their own expertise. They just started ignoring inconvenient data.
So if the problem is ego, the solution has to be humility. The book advocates for this kind of radical idea, embracing, investing.
It's counterintuitive, though.
It does. If you're a professional or even just a committed individual investor, how do you hold through a downturn if you've totally embraced your own mediocrity?
See, that's the paradox. Humility doesn't mean you get lower returns. It often means you get more consistent returns.
And the data on this is just brutal.
It's brutal. Look at the MISPA scorecard comparisons. Over a 5-year period, 88.65% of large-cap money managers were beaten by a simple passive approach.
88%.
And over 10 years, it's still stubbornly high, over 82%.
That's an existential crisis for the entire active management industry, right? You have all these skilled professionals dedicating their entire lives to this.
And they're getting outperformed by a strategy that's based purely on admitting, I don't know who will win, so I'll just buy the whole haystack.
So passive investing is really the embodiment of that humility.
It is. And it works better than trying to be special, which leads us right to what Crosby calls the diversification miracle.
Okay, lay it on us.
He shares this great example of European, Pacific, and U.S. stocks from 1970 to 2014. If you had invested in any one of those markets on its own, your best annualized return was about 10.5%.
Okay, not bad.
But if you combined them, equally weighted and just committed to rebalancing once a year, the combined portfolio returned 10.8%.
Wait, so the combination performed better than any of its individual parts?
Better than the best part.
That's the miracle.
By admitting you don't know which country will win and spreading your bets, you actually boost your total return with less volatility.
It's proof that admitting uncertainty doesn't mean you have to compromise on returns.
It gives you permission to be wrong frequently and still win in the long run.
Okay, But how do we fight that internal feeling of certainty, that feeling when you fall in love with a stock idea and you just know you're right?
You need tools. Tools designed specifically to humble your thought process.
And this is where the Feynman technique comes in. It seems so simple, but it's brutally effective.
It really is. Richard Feynman, the physicist, he used this to master incredibly complex ideas.
So how do you apply it to investing?
You force yourself to teach your investment idea in detail to a child or just a novice, someone who doesn't know the jargon.
And if you can't explain it simply,
If you can't clearly articulate the factual basis for it, the balance sheet, the valuation, the competitive advantage, without just hand-waving or using buzzwords, then your enthusiasm has probably gotten ahead of your brain.
it forces you to confront the gaps in your own knowledge.
Exactly. It strips away all the emotional gloss we put on our decisions. And if you still suspect you're being too anecdotal, you have to apply the outside view.
Right. The outside view versus the inside view.
The inside view is our default. It's our unique personal story. I have a hot stock tip, and this time it's different.
We always think it's different this time.
Always. The outside view forces you to step back and ask a different question. What typically happens in situations like this one?
And Michael Mauboussin, he outlines a really structured way to do this, right? It takes the subjectivity out of it.
He does. His 4 steps are basically the prescription for ego. First, select a reference class. So you compare your problem like buying a high-growth tech stock to all the historical examples of similar stocks.
Okay, so you find its peer group.
Then second, you assess the distribution of outcomes. What were the general success and failure rates for that whole class of stocks?
You're looking for the base rate.
Exactly. Third, you estimate the probabilities based only on that objective external data. And then, and only then, do you fine-tune your prediction based on your unique circumstances.
It's a reminder that you're not a beautiful, unique snowflake.
You're just another data point in a very, very large historical data set.
That's a really challenging shift in mindset, especially for high achievers. It's hard to tell yourself, my brilliant, unique investment thesis is probably just going to end up following the same statistical pattern as all the others.
It is, but it's so essential. Humility is the foundation. But even if we get past our ego, we still face that second big hurdle, conquering conservatism risk.
This is the risk of doing nothing, just paralysis.
And it comes from a very simple place. Our brains are incredibly expensive to run, metabolically speaking.
Thinking burns calories.
A lot of them. We're making, what, something like 35,000 decisions every single day? So our brain is constantly looking for shortcuts.
Default, the path of least resistance.
Which is almost always the status quo.
And that status quo is fiercely protected by our wiring to avoid regret.
Oh, profoundly. Research shows we feel so much more guilt, more regret, for a loss that came from an action we took.
Like selling a stock right before it moons.
Right. We feel worse about that than an identical bad outcome that came from inaction, like holding a stock that just keeps plummeting. We'd rather suffer through a comfortable misery than risk the sharp pain of a bad decision.
That explains so much about why people hold on to losing investments for way too long. Selling it makes the mistake real. It assigns blame to you.
Whereas holding on, you can still tell yourself the story that the market is wrong, and you'll eventually be proven right, even if all the evidence is screaming otherwise.
That pull toward the familiar is just, it's overwhelming. I'm thinking of that Duke study, the one with the simulated reality.
That's a wild one. They gave people a choice. Stay in this vivid, comfortable, familiar simulation or unplug and face an unknown, abstract reality.
And 59% chose to stay plugged in.
They preferred the familiar, even when they suspected it was limiting their true potential.
So the solution can't be willpower. You can't just force yourself to act, because we know willpower is a finite resource.
So the behavioral solution is to design rules to force change. You have to remove the psychological heavy lifting from the actual moment of decision.
You have to attack the anxiety that comes with change.
Absolutely. The Hyundai Assurance Program during the 2008 crisis is a perfect case study. Hyundai knew people were terrified of losing their jobs and being stuck with a car payment.
So they took that fear off the table.
They just promised to buy the car back if the buyer lost their job. Very few people ever actually used it, only 350. But simply removing the fear of that loss led to an 8% increase in sales.
Wow. So the perceived risk was way more powerful than the statistical risk.
Miles more powerful. It's a huge lesson for investors. We will pay a massive premium just to reduce anxiety, even if the actual probability of the bad thing happening is tiny.
And for investors, reducing anxiety means confronting normalcy bias.
The belief that all that has been is all that will ever be.
It's why the residents of Pompeii didn't evacuate when Vesuvius started rumbling. They just assumed it would be like all the other times it rumbled.
And for investors, it's the belief that the current calm or the current bull market is just going to last forever. The behavioral investor has to accept deep down that financial chaos is normal. It's predictable. It's frequent.
And we have the stats to prove it. That should be part of the prep work.
It has to be. Corrections of 10% or more, they happen about once a year. Full-blown bear markets, 20% or more, they come around every 3.5 years on average.
And if you're not prepared for that?
When the crisis hits, the emotional shock can literally cause a 13% drop in your measured IQ. The only way to stop that paralysis is to internalize the inevitability of chaos before it arrives.
So when it happens, you're not reacting emotionally, you're just executing a pre-existing rule.
And if we're fighting that kind of inertia, Charlie Muger's idea to invert the thinking is probably the most powerful tool we have.
Invert. Always invert.
It just reframes the decision and attacks the status quo head on. So instead of asking, should I spend $5 on this coffee, which your brain will instantly justify.
You ask, would I take a $5 payment not to drink this coffee?
Right. It's what Nick Bostrom calls the reversal test. It exposes the true value of that status quo choice. If you'd never pay $5 to avoid the coffee, then it's probably just an unnecessary habit.
And you can apply that to your portfolio. If you're holding a stock, you should ask, if I had the cash today, would I buy this position right now?
And if the answer is no, the reversal test says you should probably sell it.
This conservatism also shows up in home bias, right?
Oh, powerfully. We tend to invest almost exclusively within our own country's borders, even though capital markets are completely global.
The feeling of familiarity keeps us close to home.
Even when the objective data shows that, ingenuity and opportunity are not confined to one single place, we sacrifice real diversification just for the feeling of comfort.
It's like Mark Twain said, travel is fatal to prejudice, bigotry, and narrow-mindedness.
And it's fatal to bad portfolio construction, too. Investors have to travel financially.
Okay, so let's move to the third discipline. Say we've battled our ego, we've found the courage to take action, we still have to worry about what we're actually paying attention to.
And that brings us to On's attention risk.
The problem of confusing how easily we can recall something, its salience with its actual statistical probability.
Our brains are just not built for statistics. They're narrative machines. We think in vivid stories, not cold percentages, and that makes us overestimate these high-impact, low-probability events.
The examples are they're chilling because they show the real-world cost of this. We see a dramatic news story about a plane crash or a shark attack.
And it instantly becomes the biggest threat in our mind.
Yeah, the odds of dying from a shark attack are basically zero, but the story is so visceral.
A more tragic example is what happened after 9/11. The terror attacks led an estimated 1,595 more people to choose driving instead of flying in the year that followed.
And because driving is statistically so much more dangerous,
those 1,595 people died in car accidents they likely would have avoided. They irrationally chose the more dangerous option because the story of the plane crash felt more immediate and terrifying.
Our brain substitutes the availability heuristic, how easily something comes to mind, for the real risk calculation.
So the only solution is to divorce ourselves from the narrative and focus on the verifiable results. You have to prioritize robustness over noise.
Which means rigorously testing every single investment idea.
The behavioral investor has to subject everything to the 3 tests of an investable idea. 1, does it have empirical support? Is there data? 2, does it have a sound theory? Is there a logical reason it works? And 3,
does it have behavioral roots? The endurance test, the Lindy effect.
I think that third test is the real differentiator. It's what separates an enduring principle from just a fleeting anomaly.
Because you can always find some data and cook up a theory for some short-term effect. But if it's easy to exploit, it gets arbitraged away.
Exactly. That's the Lindy effect. The longer something's been around, the longer you can expect it to stick around. Calendar effects, for example, like the idea stocks rise at the end of the month. They had data, they had a theory.
But they failed the third test.
They failed it. Once smart money figured it out, the anomaly just vanished. But the truly enduring factors, like value and momentum, they pass that test because they're psychologically hard to do.
It's hard to buy something that everyone hates.
And that difficulty is the moat that protects the premium.
We have to learn to play the odds, ditch the story.
The smarter than a rat experiment is the perfect illustration of this. You have rats. They're in front of 2 lights, green and red. The green light flashes 80% of the time, red 20%.
The rats figured this out pretty quickly.
The rats, being rational, just play the green light 100% of the time. They get an 80% hit rate. Humans,
We try to find the pattern.
we try to outsmart the system. We look for a non-existent pattern, so we guess green 80% of the time and red 20% of the time. And our final score is only 68%. Our desire for a story actively hurts us.
We overcomplicate it, and that leads us straight into the base rate fallacy.
This is where we just completely ignore averages in favor of a specific vivid story. The classic example is the breathalyzer test problem. Let's say a test has a 5% false positive rate, but only 1 in 1,000 drivers is actually drunk.
Okay.
If the test comes back positive, what's the likelihood the driver's actually drunk?
Well, the emotional reaction is to trust the test. It's 95% accurate, so you think the driver is almost certainly drunk.
And that's what even Harvard medical students guessed, 95%. But if you do the Bayesian math, the probability is actually closer to 2%.
Wow.
The specific information, the positive test, totally overwhelms the base rate, which is the fact that 999 out of 1,000 drivers are sober.
The implication for stock pickers is huge. You hear this compelling story about a single stock.
And you forget the base rate reality. Nearly 40% of all stocks lose money over their lifetime. 64% underperform the broad market. That base rate should instantly temper your enthusiasm for any single story.
This is why the behavioral investor has to look for simple solutions.
Yes. The more complex the system, the more room there is for behavioral error. You have to prize clarity over complexity.
The story of the space shuttle's external fuel tank is perfect here.
It is. The rocket scientists were trying to shave 600 pounds off the tank, and they were looking for these incredibly complex technical solutions.
And then what happened?
A low-paid line worker, who was just focused on the obvious, suggested, why don't you just stop painting the tank?
And the paint itself.
The paint itself weighed 600 pounds. The solution was simple, obvious, and right in front of them, but the experts were conditioned to look for complex answers.
It's the same in fund selection. The single best predictor of future performance isn't the manager's genius model.
It's just the management fee, a simple brute force factor that predicts success far better than any complex story.
Okay, finally, the fourth discipline, managing emotion risk. This is all about protecting ourselves from that immediate gut reaction that can just completely hijack our entire system.
Emotion is raw power. Oscar Wilde said, I want to dominate them. And in finance, emotions make us, as one trading coach put it, strangers to our rules.
You know what you should do, but in the heat of a crash or a bubble, your own rules just seem obsolete.
And this breakdown isn't just a moral failing, it's often physiological. It happens when our willpower is depleted.
Right. The studies where people have to do a hard mental task.
Like memorizing a long string of numbers. When their limited reserves of willpower are used up, they are far more likely to choose junk food over fruit afterwards. Willpower is a resource that just runs dry.
Car dealerships are absolute masters of exploiting this.
Oh, they are. They intentionally save those high-dollar add-ons, the extended warranty, the interior protection, for the very end of the sales process.
When you're exhausted.
When your customer fatigue has totally depleted your willpower, it leads to an average of $2,000 spent on defaults that a fresh mind would just easily say no to.
So since willpower is finite, the solution isn't to fight our biases, it's to use them.
Exactly. We have to harness biases for good, a concept pioneered by Richard Thaler.
And the Save More Tomorrow program is the ultimate example of this. They realized they couldn't fight the status quo bias, that inertia of doing nothing.
So they decided to use it. They leveraged it.
Instead of asking employees to save more today, which feels painful,
They asked them to make a one-time decision to automatically increase their savings after their next pay raise.
so the decision is made once when you're feeling good about getting a raise.
Exactly. The default is set, and then the inertia of the status quo makes that increased savings behavior permanent, painless, and incredibly effective.
The scale of that single idea is just staggering. It's contributed over $29 billion to American savers.
It proves that a small, one-time decision, when it's leveraged by a structural bias, can overwhelm a whole lifetime of financial procrastination.
Another tool for managing emotion is meditation. It's really gone mainstream.
It's moved from the spiritual fringe right to the core of places like Goldman Sachs. Ray Dalio is a huge proponent.
Right. And I always thought of it as just a stress reducer. But it seems to specifically target the two big financial emotions, fear and greed.
It does. Research confirms it's effective in reducing anxiety. But what's maybe more fascinating is the study that found meditators showed lower neural activation in the brain's reward centers, the parts tied to greed.
So it creates a little bit of space between the stimulus and your response.
A cognitive distance. It helps you tame the urge to chase returns and the panic to sell.
And all these solutions, they all lead back to one prime directive: the primacy of automation.
You cannot trust yourself in the moment of crisis. The story of Odysseus and the sirens is the perfect financial analogy here.
Odysseus wanted to hear the sirens' song without crashing his ship.
He wanted the wisdom without the destruction. And he didn't rely on willpower. He physically bound himself to the mast of his ship.
And ordered his crew to plug their ears and ignore him no matter what he said.
Even if he begged to be untied, he understood his own human failing. His only choice was to pre-commit to a system of rules that took away his discretion in that moment of temptation.
For the behavioral investor, the only way to get through a bubble or a crash is to bind yourself to a rules-based, automated system.
And for those moments when the fear is really acute, you need a simple framework. The RAIN model is a great one for that kind of acute stress.
So if I see my portfolio just drop 20% in a week, how would RAIN actually work?
Okay, so first, R is for expectional. Recognize the emotion, don't fight it, just name it. I'm feeling panic and a fear of loss.
Okay.
Second, A is for accept its presence. Panic is a natural human response. It's not a command to act.
Third, I for investigate.
Investigate its cause. Is this market drop fundamentally changing my long-term goal, or is it just noise? Investigation pushes you toward the facts, toward those base rates we talked about.
And the final step, N for non-identify.
Right. Non-identify is realizing that you are more than your emotion. Your identity as a smart, long-term investor is separate from the fleeting panic you're feeling right now. RAIN lets the emotion do its job, which is to be an advisor, without letting it seize control of the ship.
And that shifts us perfectly from managing ourselves to designing the ship itself. We have to build systems that are robust to the human condition.
We're now talking about investing a third way, systems over discretion.
And the first philosophical hurdle you run into here is the active-passive paradox.
Right. If everyone just woke up tomorrow and became a passive index investor, who would be left to set the prices? Price discovery would just collapse.
You'd have massive inefficiencies. But if everyone tries to be active,
They arbitrage away all the excess returns from each other.
it's the tragedy of the commons. Or the El Ferrell bar problem. If everyone tries to optimize their own decision, the system breaks for everyone.
You need a diversity of opinions, some right, some wrong, for the market to even function.
And the pressure to succeed in active management is what creates these perverse incentives, right? The Cobra effect of measurement.
Campbell's law. When a measure becomes a target, it stops being a good measure and it corrupts the whole process.
The classic example is the French regime in Hanoi putting a bounty on rat tails to get rid of rats.
And the locals, being clever, just started cutting off the tails and releasing the rats to breed more rats.
So they could produce more tails for the bounty.
The measure became the target and completely undermined the original goal. And in finance, when a fund manager's performance against a benchmark becomes the target, they are incentivized to engage in closet indexing,
Hugging the index just enough to avoid getting fired.
even if it means they have no real chance of delivering true alpha.
And that leads to the active management illusion, where committees spend huge amounts of time and money on things that just don't work.
A big Vanguard study found that investment committees spend most of their time on manager selection, due diligence, economic forecasting,
All these really expensive, complex activities.
that add very little to actual returns. A manager's past performance is a notoriously poor predictor of their future success, and economic forecasting is basically a coin flip.
It's like spending 90% of your gym time picking out the perfect outfit and only 10% actually working out.
Exactly. The failure is often rooted in just a simple lack of conviction. One study found that for the typical active fund, the low conviction positions, the ones that are basically the benchmark, outnumber the high conviction positions 3-to-1.
So you're paying active fees for passive behavior.
A prime example of the Cobra effect.
So if human discretion is so easily compromised, the logical conclusion is that behavioral investing is rules-based. You have to outsource the decision.
And we have to be really rigorous about this. We all romanticize intuition, that gut feeling.
Yeah.
But intuition only works in stable environments where you get rapid, predictable feedback.
Like an NICU nurse detecting sepsis or a chess grandmaster reading the board.
But finance isn't chess. It's chaotic, it's luck-driven, it's heavily influenced by human madness.
So capital markets lack the three things you need for real expertise.
Right. You need predictable outcomes, static stimuli, and rapid feedback. The markets have none of those. Human behavior ensures the stimuli are always changing.
And the data on this is it's unequivocal. The system beats the expert.
A huge meta-analysis found that algorithmic models equal or beat expert decision-making in 94.12% of cases. And this included human-centric fields like predicting job turnover or psychiatric hospitalization.
The lesson isn't that investors aren't smart.
Not at all. It's that the game of discretionary investing lacks the structure for that intelligence to consistently win. Therefore, success requires not more mental toughness, but simple obedience to a set of rules.
We have to stop thinking of it like basketball, a game of individual skill, and start thinking of it more like running an assembly line. The process dictates the behavior.
And that process, that system, must be built with failure in mind. Which brings us to risk-first investing. Surviving the turkey problem.
We have to accept that crashes are not random anomalies. They are a recurrent feature of human psychology.
History shows 23 different bubbles in the US and UK between 1800 and 1940 alone. They even happen in controlled lab experiments where people know the fundamental value of the asset.
And this highlights what's called the Lucretius problem. We stress test our portfolios against the worst thing that has happened,
while ignoring the worst thing that could ever happen.
This is the turkey problem, from Nassim Taleb.
The turkey gets fed by the farmer for 1,000 straight days. Every day, consistency, food, water. The turkey gains immense statistical certainty that the farmer is benevolent.
And then comes day 1001, Thanksgiving.
A fatal, catastrophic surprise that was completely outside its historical data set. Investors who only look at the market's recent past are setting themselves up for a similar fate.
This pushes us away from the extremes then, because while we know excessive trading is bad,
the heaviest traders lose about 4% of their account value a year to costs and bad timing.
We also have to acknowledge the flaws of a pure buy-and-hold strategy.
Inaction is usually rewarded, but it can fail spectacularly. For example, the S&P 500, adjusted for inflation, was still below its 1929 peak in 1985.
56 years later.
An entire investing lifetime passed with zero real growth. If you invested near that peak, pure inaction would have failed you for decades.
So we need a middle ground, a rules-based approach to conservatism that isn't about market timing, but about avoiding catastrophe.
The goal is infrequent systematic action. Jeremy Siegel tested a simple mechanical rule based on the 200-day moving average.
What was the rule?
You buy the index when the price is 1% above the 200-day average, and you sell move to cash or T-bills when it's 1% below.
So it only triggers during clear, sustained momentum shifts.
Exactly. And when he tested it, the simple machine showed modest to healthy outperformance compared to buy and hold, but crucially, it drastically reduced the size of the losses during the big bear markets.
So it's not trying to predict the future, it's just a systematic risk management tool.
It's binding yourself to the mast. It ensures you don't jump ship completely, but it also makes sure you aren't fatally surprised when the ship hits an iceberg.
Which brings us to maybe the toughest principle for investors to swallow, because it clashes so hard with our hero narrative. No masters of the universe. Skill versus luck.
Investing is a highly luck-heavy game. It's much more like poker than chess. Success can happen by accident, performance is hazy, and you just don't get that many at-bats in your lifetime.
And this leads to the paradox of skill, which sounds completely contradictory.
It does. But as the overall skill level in any competitive field rises, luck actually becomes more important in determining who wins and who loses.
The baseball analogy is perfect. Ted Williams was the last player to hit .400 way back in 1941.
And it's not because modern hitters are worse. It's because the competition, the pitchers, the fielders, the data analysis has gotten so much better across the board.
When everyone is highly skilled, the difference between winning and losing is often just variance or luck.
The same thing has happened to fund managers. The competition is so fierce, so skilled, that the difference between the top and bottom performers is razor thin and often just attributable to noise.
So just being smart isn't enough. The solution isn't to be smarter, it's to have guts.
Meaning true conviction. And you can quantify that with a metric called active share, basically how much a portfolio actually differs from its benchmark index.
If it has low active share, it's a closet index fund.
And the data shows that skill does exist, but pretty much only among those managers with high active share. The truly active ones have historically added value, about 1.26% a year after fees.
So the takeaway is that you have to have the conviction to be different.
But most funds don't, because they're afraid to deviate from the benchmark. And this all reinforces the main thesis. You win by obedience to a set of rules, not by trying to be a master of the universe.
Which leads us perfectly into the last piece, the strategies that have actually passed all 3 tests, the sample behavioral investment factors.
And we're going to look at the 2 titans, value and momentum.
Let's start with value. Buying stocks for less than they're worth. Empirically, the case is just overwhelming.
It is. James O'Shaughnessy's study showed that $10,000 invested in the cheapest PE stocks from 1963 to 2009 grew to over $10.2 million.
And the index?
The index only grew to $1.3 million. Value delivered exponentially greater returns.
So the big question is, why has this persisted? Why hasn't the market arbitraged this away?
Because its endurance is in its behavioral root. It is profoundly psychologically difficult to do. You have to fight our innate price equals quality bias.
The pineapple example is great for this.
In the 16th century, pineapples were so rare in Europe they could cost $5,000 in today's money. Now they're $1.50. The fruit is the same, but our perception of its quality is totally different because the price dropped.
And this bias, if it's expensive, it must be good, has been proven neurologically.
The fMRI study where people drank wine, they were told the wine cost $90 and their brain's pleasure centers lit up. Then they were told the exact same wine cost $10.
And the pleasure response was much lower.
We look to price to tell us what quality is. So value investing requires you to buy the unloved, despised, cheap assets. And that's psychologically painful. It feels like you're buying junk.
And that pain is the moat. That's why the premium endures.
On the flip side of that coin is momentum, Newton's first law. An object in motion stays in motion.
What's going up tends to keep going up.
Empirically, momentum might be even stronger than value. It's worked since 1801, the world's longest backtest. FUMA in French, the efficient market guys, call it the premier market anomaly.
And its behavioral root is this powerful feedback loop created by 2 other biases.
Self-attribution bias and confirmation bias. When you buy a stock and it goes up, you attribute it to your own genius. That's self-attribution.
That boosts your confidence and confirms you were right.
So you buy more, or you hold on too long. That psychological loop drives prices way past their fundamental value. Momentum is just an exploitation of our tendency to project the present into the future forever.
The rising price convinces us we were right, which fuels more buying, which causes more rising prices, until the narrative finally breaks. This is what George Soros called reflexivity.
And that reflexivity ensures the market is never truly efficient. And it's why factors like value and momentum endure. They're anchored in these permanent exploitable bugs in human psychology.
Okay, we've covered a ton of ground. The 4 disciplines for managing yourself, the principles for designing a system. What does this all mean for someone trying to put it into practice? What's the final action plan?
It means that the path to exceptional results runs directly through embracing your own fallibility. I mean, greatness in investing is achieved by realizing you are, on average, and then you stop trying so hard to be special.
Becoming a behavioral investor is really about stopping counterproductive behavior.
Citing your ego, fighting inertia, ignoring the noise, and taming your raw emotion.
And you replace all that with a robust system. You can't rely on your own mental toughness or your intelligence. Your willpower will run out, and your brain is designed to make emotionally satisfying choices, not economically optimal ones.
The entire purpose of all this knowledge is to build a systematic portfolio, one that dictates infrequent, rules-based actions designed to survive the inevitable chaos, that turkey problem. The ultimate goal is simple, but it's profound. It's just to endure to the end.
Stop striving for perfection and start trusting the process that you committed to when you were calm and rational.
That's it. That's the whole game.
That is a profound place to wrap up this deep dive. The real challenge is just acknowledging that the market's worst enemy is often the person looking back at you from the mirror.
So let's leave you with this final thought. If consistent success in this luck-heavy, emotion-driven world really comes down to obedience to a set of rules, what mechanical, non-negotiable rules will you bind yourself to before the next crisis arrives? What's your personal mast and rope?
Thank you for watching it. Please like, say, share, subscribe, follow up in next video.